Sometimes it feels like you're sandwiched between two heavyweights, each pulling you in opposite directions. Your kids need your support, your aging parents rely on you, and you're trying to keep your own financial life afloat. It's like trying to build wealth with one hand tied behind your back. But managing this balancing act doesn't have to be mission impossible. In this video, we'll show you how to navigate the financial challenges of the sandwich generation with practical, actionable tips that can help you thrive, not just survive. Tip number 1, set up a multi-generational household savings plan. In many sandwich generation families, multiple generations live under one roof. While this can be a great way to share resources, it can also lead to blurred financial boundaries. Here's a practical way to handle it. Set up a multi-generational household savings plan. Start by sitting down with your family and discussing shared goals, whether it's saving for a bigger home, covering medical expenses, or just creating a rainy day fund. Decide on a realistic monthly contribution from each member based on their income or ability. Automate these savings into a separate account dedicated to your agreed-upon goals. This approach not only ensures everyone contributes to the household's financial stability, but also helps you avoid the stress of unexpected expenses. It's a collaborative effort that strengthens family bonds and keeps your financial goals on track. Tip number 2, leverage tax breaks and benefits for caregivers. If you're providing financial support for your aging parents or dependents, you might be eligible for tax breaks that can ease your financial burden. Many people overlook these benefits, but they can make a significant difference in your financial management. For example, in the US, you might qualify for the Child and Dependent Care Credit if you're paying for someone to care for your elderly parents while you work. Other countries offer similar benefits, like the Carers Allowance in the UK. Additionally, check if your parents qualify as dependents, which could allow you to claim them on your tax return, potentially reducing your taxable income. These tax breaks and benefits are designed to help families like yours manage the cost of caregiving. Don't leave money on the table. Research what's available in your country and take advantage of every opportunity to reduce your financial strain. Tip number 3, prioritize your retirement savings. You're likely caught up in the day-to-day demands of supporting your family. But here's a harsh truth. If you don't prioritize your retirement savings, you could end up financially dependent on your children later in life, continuing the vicious cycle of the sandwich generation. If you haven't already, start by contributing to retirement accounts, like a 401k or an IRA, taking advantage of any employer matches. If you're not sure how much to save, aim for at least 15% of your income. It might feel difficult now, but consider this an investment in your future independence. By securing your own financial future, you're also relieving your children from the burden of supporting you later on. It's a gift to your future self and to your family. Tip number 4, discuss financial responsibilities openly with your family. Many of us avoid talking about money with our families. It can be uncomfortable and even taboo. But when you're supporting both kids and parents, clear communication is key to avoiding misunderstandings and ensuring everyone's on the same page. Schedule a family meeting to discuss financial responsibilities. Talk openly about what you can realistically afford to contribute and where you might need help. Maybe your parents can contribute to their own expenses, or perhaps your teenage kids can take on part-time jobs to cover some of their wants. By setting expectations and making a plan together, you reduce the risk of resentment or financial strain. It's about creating a team approach where everyone understands their role in the family's financial management. Tip number 5, use technology to track and manage caregiving costs. The cost of caregiving can quickly add up, especially when you're juggling multiple financial responsibilities. One practical way to manage these expenses is by using technology to track and manage them effectively. There are apps and online tools designed specifically for caregivers that can help you keep track of medical expenses, prescriptions, and even the hours spent on caregiving duties. Some apps even allow you to split costs with siblings or other family members, making it easier to share the financial load. By using these tools, you not only stay organized, but also gain a clear picture of where your money is going. This insight can help you make more informed decisions, budget more effectively, and even provide documentation if you need to claim any tax deductions or benefits related to caregiving. Tip number 6. Consider long-term care insurance for your parents. As your parents age, their healthcare needs will likely increase, and the costs can be staggering. Many families are caught off guard by the high price of long-term care, which can quickly drain savings and lead to debt. One way to mitigate this risk is by looking into long-term care insurance for your parents. While it might seem like an added expense now, it can save you and them significant money in the long run. Research different policies and discuss the options with your parents. Having this safety net in place can protect your family's finances and ensure your parents receive the care they need without jeopardizing your financial stability. Tip number 7. Optimize your mortgage to free up cash flow. If you're a homeowner, one of the most practical ways to ease financial pressure is by optimizing your mortgage. Refinancing your mortgage to a lower interest rate or extending the term can significantly reduce your monthly payments, freeing up cash flow for other essential expenses like caregiving or education costs. Start by shopping around for the best mortgage rates, or consider talking to a financial advisor who can guide you through the process. Be sure to calculate the costs associated with refinancing to ensure it's worth the savings. By optimizing your mortgage, you can create more breathing room in your budget, allowing you to allocate funds more effectively and reduce your financial stress. We talked earlier about getting your retirement savings in order, and there are some key areas to look out for in this process. So, watch this video next to see if any of the 8 typical retirement red flags apply to you and how you can fix them.